Good evening, everyone. Hope you're having a nice night. And I also want you to understand that when I gave this little presentation, the title of Most Important Technical Analysis Lesson You'll Ever Read, I honestly believe that. And I'm not saying I'm some kind of genius or I got some secret system, but what I need to convey to you is that trading and chart reading really ultimately comes down to psychology. It's understanding your own psychology, it's understanding why you make mistakes, why you make profits, but it's also about understanding the market. And when we look at a chart, what we're looking at is a graphical illustration of psychology, of the aggregate investor psychology. Now, if you go back through the beginning of markets, which who the hell knows when they started, Egypt, maybe, Mesopotamia, investors back then felt emotions. They felt buyer's remorse. They felt seller's remorse. It's the same thing that's going on now, and it's the same thing that's going on for hundreds of years. So what I'm going to do now is I'm going to bring up a chart of XLK. This is the technology sector ETF because this really right now is just a really good illustration of what I'm talking about. All right, now let's just take a quick look on here, and then we're going to stroll down Wall Street history. Notice here how this level over here was support, and then it converted into resistance. Now you don't need to be a former hedge fund trader, which by the way are a dime a dozen these days, to see that this particular level is important. Some price levels are important. Some price levels aren't. Why? Because of psychology. Now there's a bunch of investors who bought XLK back here, and at first they thought like they did a good thing when the price went higher, but eventually it goes lower. So a lot of these investors who bought a pair, they experience buyer's remorse. They say, "Oh man, I shouldn't have bought it. I want to get out of break even if I can." If you have enough of these remorseful buyers placing sell orders at the level that was support, support can turn into resistance. This level here is important. Wall Street is, outside people or people that aren't on the street, they think it's way more sophisticated than it is. Well, let me tell you something. If you can understand psychology and if you can understand supply and demand, you could be on your way to making profits because you can understand how to read charts. This level is important. Why? I don't know, but I don't need to know. Do I need to know, or do I know how electricity works? No, but I know if I flick the switch, the power comes on. So support turns into resistance because of buyer's remorse. Support turns into resistance because of buyer's remorse. I mean, look at that. It's pretty darn clear. Okay. Now, there's another thing buyer's remorse does. It keeps resistance sometimes. There are people who bought here who wanted to sell over here. They bought and they're underwater and finally gets up to their price and they're like, wow, if I can get out of break even, I'm going to. So not only does buyer's remorse turn support into resistance, it can also keep resistance intact for a while. It's not a coincidence that this is where this rally stalled out in June. It's because it got to a former resistance level. And let me well, you know what? I don't need to label it. You can see it. So you see, and this is really profound. How is it that the sector that's worth trillions of dollars could have the exact same valuation here as it does here? It doesn't from a fundamental point of view, but from a psychological point of view, it makes sense. So buyer's remorse can turn support into resistance. Buyer's remorse can keep resistance intact. Now let's look at the other side of the equation here. Seller's remorse. Seller's remorse can turn resistance into support. There are investors who sold here who regret doing so when the price goes higher. So they tell themselves, I'm sorry, let me just set this up right. So they tell themselves, man, I made a mistake selling. If I can buy my shares back at the same price I sold them at, I'm going to do so. If you have enough remorseful sellers placing buy orders at the level that was support, it turns resistance into support. Let me say that again because I think I messed it up. If you have enough remorseful sellers placing buy orders at the level that was resistance, it turns into support. Again, you don't need to be a market guru. If you want to profit, you need to know where these levels are because they will tell you where to put your orders. Resistance turns into support. 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 Seller's remorse. People sell, the price goes higher, they regret selling. They tell themselves, man, if I could buy my shares back at the same price I sold them at, I am going to get out at break even. Now, not only does seller's remorse have the ability to turn resistance into support, it also has the ability to keep support intact for a while, just like buyer's remorse can keep resistance intact. So you get, let's just go back here. You get investors who sold here, and when the price goes higher, they regret doing so. And they tell themselves, I made a mistake. I'm going to buy my shares back if it gets back to the price level that I sold them at. And if they're enough, it becomes support again, and so forth. So buyer's remorse can turn support into resistance. Seller's remorse can keep support intact for a while. Why do we bounce off of support? Well, markets go lower because there's not enough buyers to absorb all of the supply. So the sellers have to be really aggressive and push the price down. When we get to support, a lot of the traders or investors notice, wow, I wanted to buy, but the price isn't going down anymore. That must mean there are new buyers coming into the market. So I'm going to go out to the market and I'm going to try to outbid them, because the seller's going to come to whoever has the best price or the highest price they're willing to pay. So you get the snowball effect. You get these investors want to buy, outbidding each other, and you get the snowball effect. Why do things sell off of resistance? It's the opposite. Investors want to sell, and markets go higher because there's not enough selling or supply to absorb all of the demand. So when we get to a level where the price stops moving higher, some of these investors assume rightfully, oh, gee, there must be new sentiment to the market. That's why the price isn't moving any higher. If I want to sell, I better reduce the price I'm willing to sell it, because the buyers are going to go to whoever is willing to sell to the lowest price. So you get anxious sellers knocking the price off of resistance. You get anxious buyers bidding the price up off of support. It's not because of, the debt ceiling or whatever the news story of the week or the month is. It's because of psychology. And if you can't look at charts through the prism of market psychology or human psychology, I don't think you're ever going to be successful. Now, I'm going to show you a really cool chart here. At least I think it's cool, but I'm a chart geek. But it's really more of a human psychology thing. So what I'm going to do here is I'm going to put up the Dow Jones chart since it started. The Dow Jones first started back in 1897 when Charles Dow founded the Wall Street Journal. He created this index to just keep track of the stock so people could have an idea of what was going on. Now, maybe there were people that had charts before that, but unfortunately, if they have, they've kind of been lost to history. But let's go back here and let's just talk about some of the same principles that we just talked about. Human psychology. The people are different. The names have changed. The companies have changed. The technology has changed. But what hasn't changed is this human psychology. Resistance in 1896 became support in March of 1898. Resistance in September of 1897 became support in 1900. Why would that happen? Seller's remorse. People sell and the price goes higher and they say, gee, I'm going to buy my shares back. Gee, the price went higher, I'm going to buy my shares back. So just like now, we can see seller's remorse on a chart. If we look at a chart from literally 120 years ago, we could see psychology. We could see seller's remorse, just like now. As a matter of fact, if I told you, hey, this is a chart of stock XYZ that went back for a year, how would you know how would you know? How would you not know that this is, or how would you know that this isn't that? I mean, this stuff is impossible to understand unless you understand the psychology. If you understand the psychology, all of a sudden it's not so mysterious and it's much easier to understand, and makes things much easier to make a profit. Now, why would resistance in 1899 become resistance in 1901? Okay, I wish I'd get a drum roll, but buyer's remorse. There are people who bought here who regret doing so, and the price goes lower, and we get back up to a level that was resistance. Support becomes resistance. Resistance stays intact. Support becomes resistance because of seller's remorse. Resistance can stay intact because of buyer's remorse. Now let's look here. We got our support down here in March of 1898. Where were you back then? I guess I was floating around in heaven as an angel. But support in March of 1898 became support in October of 1903. Seller's remorse. There are people who sold here who regret doing so. They tell themselves they're going to buy their shares back if it gets to the same price. Why do things bounce off of support? Anxious buyers outbidding each other. Maybe things took longer back then because we didn't have the transportation or the communications network and so forth. But you can see on the chart the same stuff applies. Now, if someone was to tell me, try to explain this to me, where they were telling me how these levels somehow could manifest each other and the millions of people that are trading could all somehow come together and make this happen, I would be very questionable. But then if you look at a chart, it's like, dude, it's pretty darn obvious. Support in August of 1910 became support in October of 1911. Resistance in 1906 and 1909 became support in August of 1917. I mean, look at it. I don't need to sell a used car here. It's pretty obvious. Just look at the chart. Psychology. Seller's remorse. People sell and then all these years later buy their shares back. I mean, it's hard to believe, but you can see it on the charts. And this is what we call market memory. So let's just kind of advance here through time. And I think this is a pretty amazing thing too. So this is the Great Crash or Black Friday or the market crash and then go into Great Depression. This sell-off from July or I think it was October of 29, where did it find support? Right around 40. The same level that was support in 1907 and the same level that was support in 1900. This is just a clear example of how some price levels are more important than others. And in my philosophy or my way of looking at things, technical analysis is about levels, trends, and momentum. Here we go again, right? So now we're in the 50s. We're in the era of happy days and, big cool cars, which are much nicer than the ugly cars they have now. The Korean War probably just ended back here. So we have resistance in May of 1956 become support in June of 1962. How could this possibly be? Well, if I didn't understand that what we're looking at psychology, I wouldn't be able to give you an answer. And you might say, well, how is it possible that these levels can stay intact for so long? And let me tell you something. I've been thinking about this stuff for 30 years. I've worked with some of the best traders literally in the world. And it's like, I still can't get my head around it. I still can't. But if you look at it on the charts, somehow this mass psychology manifests itself in it coming to these precise levels. And it's not like everyone in the world who trades this stuff is getting together and saying, hey, let's buy it here, let's buy it there. Not everyone's looking at the charts. As a matter of fact, most investors I know don't look at charts, but it happens. And it's an amazing, amazing thing. And I think a lot of people just take it for granted. Here, resistance in October of 61 becomes support in September of 66. Look at this. Again, we're looking at the Dow Jones here. Resistance around 1966, 69, November of 72, April of 76, March of 1981. This is the $1,000 level. So this is a perfect example of market psychology. Investors like round levels. Back then, they didn't have ETFs. But this is literally brokers all over the world getting orders from their clients saying, oh, you know what? If it gets to 1,000, let's sell. If it gets to 1,000, let's sell. We get to 1,000, we sell. Or we go lower. What happens here? Well, just like we talked about before, you get anxious sellers undercutting each other. Why do we get support and we bounce? You get anxious buyers outbidding each other. Support, seller's remorse keeps support intact. Buyer's remorse keeps resistance intact. Now let's move up to our current day here. Okay, so here is... okay, this is coming out of the housing blow-up. Resistance in April of 10 becomes support in September of 11. Very clear. It's not even a debatable point. Resistance in 2015 becomes support at the bottom of the COVID crash. I'm just going to make the wick easier to see there. And remember, these are month charts, so I'm going to spend a week or two down there. Resistance in December of 19 becomes support in August of 22. All right, everyone, I just wanted to re-emphasize that if you really want to understand technical analysis, don't get too caught up in this, silly stuff like Elliott wave or, GAN theory. I mean, if you want science fiction, I would recommend early Twilight Zone or maybe Star Trek, or if you like to read, maybe some Ray Bradbury. In the institutional world, no one looks at that stuff. The most savvy traders let the market tell them what to do. They think about what price levels are important, what's the trend, what's the momentum, and what's the psychology. All right, so hopefully that helps you out a little bit. I do think it's the most important technical analysis lesson you'll read, because the important thing about technical analysis is psychology. And that's what I try to emphasize on. And human nature, which doesn't change or hasn't changed in at least the last couple of thousand years and probably won't change in our lifetime. Okay, everybody, thank you so much and have a nice night.